Hello everybody, today we're going to go over IT stocks and why they're a bit different in terms of verticals. And we're going to go over two main points for this. It's the margin and it's the growth. And then in the end we're gonna do a summary and an example of how to think. First of all, IT stocks, the tech sector. We all remember the early 2000s and the IT bubble when the market burst like a hot balloon that came too high up in the atmosphere. But today we're a bit wiser and we have some general truths that you can think about when you invest in IT stocks. First of all, let's look at the margin. A lot of these tech companies, they sell licenses, software, just like gaming companies or data analytics. And what you have here is that once you've done the research and development, there's no additional flexible cost. Maybe commission for the sales guy, but not a lot else. So once you've done that research and development, you can just sell and you have an extremely good margin on that. Now also we have growth. And if you look at, for example, a more traditional company such as Coca-Cola, it took them years to develop their global distribution network, to have a vending machine out there in every country. For example, they used the Vietnam War to get out into Asia and that part, and have a Coke for every soldier. And if you look at a company like Google, that's relatively new, they managed to reach global coverage via digital channels so that everyone can use AdSense, AdWords, Google 360. They got global coverage very fast. So there's a high potential for growth using these digital distribution channels. But what we also need to take into consideration then is that it's a high risk sector. If we look purely at the mathematics when you do a stock evaluation, growth is denounced as the little g in the bottom half of the division as a subtraction. So that means if you factor in a lot of growth, then the stock is going to be very highly evaluated. Now let's summarize this. What I really want you to bring with you when you look at tech stocks and IT is don't buy the air castle. Look at the underlying company. Is it a good idea? Is it a good service? Now, a personal example for this is when I looked at a ad exchange. It was below $2, it was heavily hammered in the stock market, and they did the software update that added some new features that made the service a lot better for its business-to-business users, and it also addressed the issue that they had with being open and transparent. So when I saw that, I realized, okay, they're doing something good, they now have a very good service, and this underlying business is something that I feel comfortable investing in. That was a year ago. Today the stock is up 400%, and there's been no calculations involved, no doing the DuPont formula, no looking at PE values, no complex math whatsoever. It's been a decision made purely looking at the underlying business, understanding the business. Is it a good idea? Is this a service I would use? What does it consumers think about it? Just common sense, really. And that is what I want to bring with you today. Just look at the underlying business, use common sense, and don't buy the air castle. Thank you very much for listening.